Good morning. I am Kawanishi, Chair of ASBJ. Thank you very much for coming here, and I'm happy to be serving as the panel discussion moderator. I'm going to be speaking in English from this point and beyond, so those of you who wish to listen into the Japanese translation, please use the receiver. Japanese will come through channel 1.
So now I'd like to start this panel. And as you know, the Japanese securities law permits the use of US GAAP to prepare financial statements to be incorporated in the annual report. And so it's very important that the Japanese stakeholders understand US GAAP. And now that the number of companies are not that much as it used to be, it continues to be a very important part of our financial reporting regime. And today, we are very fortunate to have this fabulous suite of panelists today. So let me introduce each panelist from the near side. First would be the chair of the FASB, Mr. Richard Jones. Can you do a self-introduction, please?
Hi, good morning. It's great to join all of you here today. My name is Richard Jones. I'm the current chair of the Financial Accounting Standards Board. I became chair approximately 5 years ago, and I was appointed to one 7-year term, so I have a little less than 2 years left. Prior to being appointed to the Financial Accounting Standards Board, I spent my career in public accounting, spent over 30 years in public accounting. I was a partner with Ernst & Young, and my last role prior to joining the FASB was as EY's chief accountant. But I look forward to our panel discussion today and look forward to meeting many of you afterwards. Thank you.
Yes, thank you, Rich. Next, I would like to ask Hillary, the vice chair of the FASB, for your introduction.
Good morning, everyone. So I'm Hillary Salo, the vice chair of the FASB. I became vice chair last year after previously working as the technical director in Jack's job for 4 years. Previous to that, I spent my career in public accounting. I was a partner at KPMG and also completed time at the Securities and Exchange Commission as well. I also started my career at the FASB as a postgraduate technical assistant right out of college. So was able to come back to this organization has been a real pleasure.
Thank you very much. And last but not least, Mr. Jackson Day, technical director of the FASB.
All right, we'll try that again. So my name is Jackson Day. I am the technical director, which means I lead the staff of the FASB. I've been in that role for approximately 1 year. Prior to that, I had a long career in public accounting at EY. I also previously was a practice fellow at the FASB, and I also worked as Deputy Chief Accountant and Acting Chief Accountant of the SEC for approximately 3 years back in the early 2000s.
Okay, thank you very much. And I'll introduce myself a little bit. I'm Nobu Kawanishi, Chair of the Accounting Standards Board of Japan. But I have been an international fellow of the FASB from 2004 to 2016. So I do have experience working with Hillary when she was at the FASB a very long time ago. So if I remember correctly, the FASB celebrated its 50th anniversary very recently. And there's, I think, a lot of experience that you've gained and a lot that we can learn from. But just to set the scene, can you give us an overview about your organization and how you develop your standards? And I think you have prepared some slides for us, so I might just, I'll do the operating.
Absolutely. Thank you, Nobu. Yes, you're correct. We've been around, the FASB's been around for approximately 51 years. I think one of the reasons that the FASB has been sustained for that period of time is we have a very narrow focus, but we're also very focused on the fact that we earn the right to set standards every day. There's no mandate that the FASB is the only standard setter. We're evaluated by the quality of the standards we set and how they serve the capital markets. If we move to the next slide, this is our mission statement. I recognize it's in English, so let me read it for all of you so the translator can translate. It's to establish and improve standards of financial accounting and reporting that foster financial reporting by non-governmental entities that provides decision-useful information to investors and other users of financial reports. Couple key points in there. Our mission is solely around financial accounting and reporting. That's what we do. It's the numbers, the performance of a company is reflected through its financial accounting results. The other part is the focus on its use by investors. And the way I would say that more directly is we're focused on improving and maintaining financial accounting and reporting for capital allocation purposes. That's it. It's not for any other purpose. There's lots of other things people might want to do with that information, but that's our focus. That's how all of our standards are developed. That's the focus that we have, and that's the singular focus we've maintained for over 50 years. And I think that has contributed to the longevity of the organization. Doesn't mean we don't change. There's always changes in the business environment. There's new accounting issues, new transactions. We have to address those. But to be fair, if you flip to the next slide, if you look at our board members, we're accountants, we're preparers, we're former auditors, former preparers, we're accounting academics, and investors who actually use the financial statements to make or work with those who make capital allocation decisions. That's what our expertise is, and that's why we're focused on that, and that's how our board is developed. I would note that when you look across our 7 board members, the key is the different backgrounds. But while we come from different backgrounds, we all have the same shared mission, which is how you improve financial accounting and reporting for capital allocation purposes. Moving to the next slide. One of the questions you may have is, well, what's the output of all that? And let me turn it over to Hillary, our vice chair, to give you a little detail on that. Hillary?
Sure. So when we talk about our standards, you may be familiar with the references to accounting standards updates. And that's really how we communicate changes to the FASB codification, which is kind of your one-stop shop for all of accounting guidance in the U.S. So those accounting standards updates, or ASCs, are our source of authoritative accounting standards. It tells you how we're going to change the codification to address the decisions that were made by the board during our decisions. One thing that is helpful, though, is those accounting standard updates that are issued. They not only tell you how we're changing the codification, they also give you things like the basis for the board's conclusions, which is really important if you're trying to kind of understand how to interpret and apply the guidance. It can be really helpful to have that background and summary of what was considered by the board and how did the board make the decisions that are being reflected in the codification. It also tells you which board members agreed or didn't agree with the guidance. Right? At the FASB, we have a 7-member board, and we need a majority to be able to make final decisions. In certain instances, that will mean that we have board members who have different perspectives. So you may see things like dissenting opinions with regards to some of our standards. One of the items from the FASB perspective is any authoritative guidance ends up in the codification. So any changes that the board makes in a project will be reflected in our one-stop shop of the codification. We do not often issue non-authoritative guidance at the FASB. In certain cases, we will have the staff, for example, issue staff educational papers. But those are simply to help explain existing GAAP. They are not intended to change GAAP. Any guidance that is coming out as authoritative by the FASB has to have been approved by at least a majority of the board. If we move to the next slide, I think, when we think about, well, how do we've kind of jumped to the very end, which is we've made changes to GAAP and those end up in the codification. But what is our process for how do we get there? This is really our 11-step process for the standard setting process. But it really starts with agenda requests. It starts with us being able to identify issues that are high priorities for the board to address. Now, those agenda requests can come from a number of different groups. It can come from individual stakeholders who will send us agenda requests. It could come through our advisory groups who may identify certain areas that need to be addressed from their perspective. It can also come from our regulator. We could get suggestions from our regulator with regards to issues that should be addressed, or areas where we're seeing common questions come through in technical inquiries. So once we have those agenda requests come in, our staff under Jack's tutelage help to evaluate the merits of those agenda requests. So they'll do some initial research and outreach and then come back to the board for an agenda decision. Well, we'll decide whether or not to add a project to the agenda. We do have 3 criteria that have to be met in order for the board to add a project to the agenda. The issue has to be pervasive, it needs to have technically feasible solutions, and it needs to have a defined scope. If the board decides to add a project to the agenda, then we will have a series of different meetings after the staff has researched the issue and come back with suggested recommendations for the board on the direction of the project. Depending on the different type of project, these can be, very short-term projects, something that we may see coming back very shortly after we decide to add a project to the agenda. It could be things where we're doing those initial deliberations for, a year or so, or a little over that, to really get into some of the difficult areas associated with some of our projects. Now, once we do that, when we make those initial decisions, we then issue a proposed accounting standards update. And that's when it really goes out to the public for public comment. And that's an incredibly important part of our process, because that allows us to make sure that our stakeholders are helping to identify if there are any challenges or issues with the decisions that were made by the board or how that might be implemented. Once we're able to get feedback, not only from our stakeholders through our public exposure drafts, but also through talking with our different advisory groups, we'll bring that back to the board and have discussions in what we call redeliberations phase. And that's where we're really talking about the feedback that we've heard and deciding whether or not that means that we can, make certain adjustments to clarify items and move forward with the guidance that we proposed, or whether we need to fundamentally relook at some of the decisions that were made based on the feedback that was received. So assuming that we're able to move forward, if the board agrees after redeliberations and we have a majority of the board, we can issue a final standard. But that's not the end of our process. We really help to make sure that our stakeholders understand the implications of those issues and how they will apply the guidance. So helping from an educational perspective, from an implementation perspective, we may put together resource groups and others to help bring stakeholders together to understand some of those issues. And then we also do a post-implementation review process for some of our more major standards.
Okay, thank you very much, Rich and Hillary, for the introduction about your organization and how about the standard setting process. My understanding is that setting the agenda is very important because once it's on the agenda, it's likely that standards will change, which means practice will change. And one, I think, Hillary, you mentioned several ways you get input for the agenda setting process, but I think the so-called agenda consultation is a very important part of that process. So maybe I would like to move on to that part of your process. So Rich, you became chair in 2020, and then you immediately did your first agenda consultation, and then you're doing your second one this year. Can you talk a little bit about your agenda consultation process and what is different from your first agenda consultation versus your second one, and if there's any difference between the ISB's agenda consultation? Can you touch on those points?
Sure. Thanks, Nobu. And when we say agenda consultation, think of that really as outreach to our stakeholders, to get our stakeholders' input on what should be the priorities of the FASB. And for our 50 years of existence, we've done outreach with our stakeholders. And as Hillary mentioned, there's lots of different ways projects can end up on our agenda. But back in 2020, we took a look at our agenda, we took a look at the way we were interacting with our stakeholders, and we decided to try something slightly different in our outreach with stakeholders. And we effectively went out to a group of stakeholders, over 200 stakeholders, with a question. And we said, what should be the priority of the FASB as it relates to financial accounting and reporting? We didn't bias, we didn't try to lead them to a specific project that was Rich Jones's favorite project or Hillary Salo's favorite project. But we really wanted to know, what do they think our priorities should be? We took the results of that outreach with over 200 stakeholders, and over a third of those, by the way, were investors. And we brought it back and we populated a document that we call an invitation to comment. An invitation to comment doesn't have any board views. It doesn't have any, this should be the accounting for X or Y or getting, it simply conveys all the things that we heard from those over 200 stakeholders, and we put it out for public comment to all of our stakeholders. I will tell you the response to that was terrific. As a result of that response, back in 21 and through 22, we comprehensively reset our entire agenda. We had some long-standing projects on our agenda. Believe it or not, some had been on or off for over 20 years. We had some that we had never thought about addressing before, but we comprehensively reset it. And it was really reset based on the priorities of our stakeholders and what would affect the capital markets and provide higher quality information in the capital markets. If you move to the next slide, Nobu, I thought it might be helpful to give you some ideas of some of the things we heard. And some of the things that we heard back in 2021 was there was an absence of appropriate GAAP for the accounting for digital assets. That would be one example. So under US GAAP, digital assets, so think Bitcoin, the model that commercial companies were following under US GAAP was if they purchased it, they recorded it at cost, and then they continuously marked it down to lowest trading price. It was an impairment model without any ability to recover. Well, if you think about an asset that can move up and down and it's widely traded in the market, we often hear that fair value is a better measure of that volatility and a better measure of the transparency of holding an asset such as a digital asset. As a result, the FASB looked at that, we did standard setting, and that's the accounting for digital assets today. That's something we've completed. We'll talk about a few of these other projects on the left side, but one thing I want to emphasize is you'll see that there's 7 or 8 projects under a column called final standard issued or expected to be issued. That's fairly rapid progress. When you think of projects as broad as income tax disclosures, disaggregation of income statement expenses, which, by the way, had been on our agenda in one form or other for 20 years, the accounting for government grants and the accounting for software, we were able to complete the standard setting, or will be completing that standard setting in 2 to 3 years. That's, for us, that's pretty fast. And some of these are fairly comprehensive projects. But it was all shaped by that open-ended input that we got from our stakeholders as we asked them, what should be our priorities and what do you think the solutions to certain issues you're seeing should be? On the right side, we have a few other projects. We have accounting for environmental credits. That we'll talk about a little later, maybe. But that's another item that we heard is an emerging issue that was out there and that we should focus on, and that there really was an absence of relevant GAAP to. When we return back to the U.S. This weekend, next week, we'll be having a board meeting where I'm optimistic we'll be resolving and wrapping up that standard. So there's 2 items that I've listed on the bottom, and we can talk about maybe a little more later, are invitations to comment on financial KPIs and intangible assets. Those are 2 areas where we very often heard people had an interest or suggested we work on standard setting, but when you talk to people and look for what information they'd find helpful or what possible solutions, they were extremely varied. So that's something where we're doing some additional work. But between the items on this slide, and if you look at the technical agenda on our website, right now on our website, there are 12 projects on our technical agenda. We expect 10 of those to be finalized and issued before the end of the year. That means we certainly have capacity to take on additional standard setting, focus on additional priorities of our stakeholders. So we've instituted a similar process to what I described to you back in the 2021, 22 timeframe just this year. In January of this year, we once again went through that process, talked to over 200 stakeholders once again, over a third of them were investors, populated an invitation to comment and issued it for public comment in January of this year. The comment period just closed, so it had a 6-month comment period, and our staff is now working through all those responses. I think Jack will tell you there's over 1,200 pages of comment letter responses with suggestions on different things that we should work on, as well as suggestions of things we shouldn't touch that our board will be talking about in public meetings over the next year. What that will be doing is effectively reshaping our agenda once again for the next 3 to 4 years. Nobu, I know you asked differences with the IASB, and I think that one thing that all standard setters share is the need for our stakeholders to participate in our process. So I believe there's a similarity there, definitely with the IASB. I think what is slightly different is both our current agenda consultation for 2025 and the prior one that I described in detail it started much more open-ended as opposed to with a listing of items that we thought we should focus on. So that might be the one difference. But I think the objective of all of them are the same, which is to find out what's the key priorities for the capital markets and how you can address those.
And maybe one other, I would say, difference between the ISB and the FASB is we don't have a requirement to go out for an agenda consultation at a specific time. It's not, for example, on a 5-year interval. So this was really, from our perspective, trying to look at the progress we've made on our existing agenda and realizing that we were getting near the completion of many of those projects and therefore wanting to go out to our stakeholders to repopulate the agenda. So I do think it provides us with some additional flexibility, right, to be able to address those issues as they're necessary based on the status of our different projects.
Yeah, the one thing you don't want to do is go out to your stakeholder and say, hey, what do you think we should be working on? And them tell you the same thing I told you last time, you just haven't finished it, right? So it is key to be able to finish it and adjust the timing of those inquiries appropriately.
Yes, thank you very much. These 7 projects that are already completed is very impressive, I would say. So I think Rich mentioned that the comment period closed at the end of June, and your staff is going through the papers, and it will be discussed by the board in the near future. But Hillary, do you think you have any initial or preliminary observations on what you've heard, just quickly skimming through those comments?
Sure. It's pretty helpful to understand, I think, a little context. The last time that we went out for an agenda consultation, about 5 years ago, we heard some very consistent themes that the FASB should address issues related to disaggregation of financial reporting information, as well as to address the accounting for emerging types of transactions. And that's really what drove the final standards that are issued or expected on this slide, was really focusing on those type of projects which generally align themselves in either the disaggregation bucket or in the emerging type of transactions bucket. When we went back out for our agenda consultation process this year, again, we went and did speak with 200 stakeholders as part of this process again. We heard some slightly different feedback. One, they were pretty happy with the progress that we had made on the priorities from our last agenda consultation process. And 2, they had probably more focus on more narrow specific issues, which were probably more relevant based on the type of entity or group that we were talking to. So they had less, I would say, of those general themes and less requests for broad-based standard setting on major projects. But what happened is we take all of the feedback that we get in that initial consultation process, and we actually put it in the invitation to comment for stakeholders to react to, right? Sometimes it can be easier to read somebody else's potential priority and then comment on that. And so that did result in our invitation to comment. I believe it had something like 40 issues or more of different areas that our stakeholders believe should be priorities. And so we have gotten back those comment letters. We are still digesting. That's a lot of information to digest in a couple of weeks. But I do think we're seeing some of those similar themes of maybe not having consistent views of, a majority of our stakeholders with regards to exactly what projects should be priorities, but really highlighting a few key areas that we've seen probably more interest across stakeholder groups. Certainly disclosures is one. We've heard from investors specifically that they would like enhanced disclosures to provide additional transparency related to a variety of different transactions. But then on the other side, we've also heard from preparers that they would like us to focus on removing outdated disclosures. I think this is a great example of where we get feedback from our stakeholders that can be very different, right? They can have different objectives and priorities, and it's really our job as the board to be able to take all of that feedback in and figure out what is the path forward to be able to address as many stakeholder priorities as possible. We've also heard feedback with regards to certain projects like hedge accounting, for example. Looking at that and making sure that hedge accounting is reflective of entities' economic hedging relationships. And that's something that we heard some more consistent feedback on from our preparer groups and from our auditors as well. And we've also heard some, I would say, feedback with regards to things like the equity method. Right, the application of the equity method in the U.S., how do you apply the equity method? It can get fairly complex in certain types of transactions. So we've received feedback that entities would like us to be able to, in some cases, simplify that guidance, which could mean wanting us to provide a measurement alternative. In the U.S., we do have the ability to apply the fair value option for equity method, but there has been a request for us to be able to let entities apply a measurement alternative, which would say you don't have to apply the fair value unless there's been a transaction in the marketplace to be able to provide that guidance. So I do think we're still digesting the feedback, but those are some of the broader themes. But I do think it can be a little bit more challenging in this agenda consultation because there isn't as much consistency among the different projects that are of interest to our stakeholders. But that's what makes this job fun, right? Is to be able to hear all of that different feedback and to help figure out how we can prioritize and focus on those areas that are going to be the most valuable from our stakeholders' perspective.
Thank you very much. Let me ask you two questions that actually came from the audience when they registered for this event. The first question, and these two relate to the agenda consultation or how you get items on the agenda. The first question is, does Congress or the SEC, the regulator, ask the FASB to work on specific projects, and do they ask for specific outcomes?
Yeah. So let's talk about the SEC first. Obviously, as the primary regulator in the U.S. financial markets, they see transactions and they see accounting real time. And they see it across the markets. So occasionally they'll see areas where they think there's diversity in practice or possibly where accounting could be improved, and they may suggest them to us. But I would observe that we're an independent board. And while they may suggest it to us and we would bring that to our board, it would require a majority of our board to A, add it to our agenda, and then B, select a solution. So those are independent processes of that. As far as Congress, individual elected officials will very often hear from their constituents. They might be in a district in Ohio. There might be a local banker who has a view on some of the accounting that they have to apply in their financial statements. To the extent they share that with an elected official, we may hear from that elected official about an potential accounting issue. typically what we'll do is we'll ask to engage with their constituent, with their local citizen, and to understand what their issue is and what they would like to pursue. So I would tell you the SEC and Congress don't mandate the standard setting we do, and they don't mandate the outcome. But just like any stakeholder, when someone has a suggestion or an observation for us on the way financial accounting and reporting is working, we certainly listen. And we need to look at that and understand if there's an issue there and if there's an improvement that we need to make. But we are an independent entity, but it doesn't mean that, that doesn't mean you ignore people by any means. You still engage and listen to them.
Yes, thank you very much. I think that was very clear. The second question is, understanding that the FASB's remit is limited to financial statements or financial accounting and reporting, does the trend around the world require sustainability reporting? And this person who's asking the question is focusing on human capital. But does that have any impact on the FASB's agenda?
So let me bring it back. So you mentioned sustainability accounting and international accounting, so two separate items. So I come back first to our mission. Our mission is financial accounting and reporting. So we are not a standard setter that would say this is how you measure greenhouse gas emissions, or you have to measure it for either yourself or your customers. That's outside the scope of what we do. We would not address that. On the other hand, companies face all different kinds of risks. So to the extent that there was an effect on a company's operations due to government regulations, due to customer preferences, those things and how they're reflected in the financial statements, they're reflected today. To the extent we ever needed to make adjustments for something like that, that's obviously something we could look at. But it's focused solely on financial accounting and reporting. As far as U.S. GAAP versus international GAAP versus Japanese GAAP, we do recognize that there is a global marketplace. We also recognize that even for U.S. multinationals operating in foreign jurisdictions, they may have to prepare local financials under IFRS while they're preparing their U.S. consolidated financials under U.S. GAAP. To the extent those two are aligned, there's a reduction in cost. There's no doubt about it. So we do look at that and look at the alignment between U.S. and international standards, both from a preparer perspective, on the cost perspective, but also from investors. To the extent investors are investing in an automotive company and they're looking at financials for a U.S.-based or a Japan-based or a European-based company, there is a benefit to investors that those financial accounting and reporting are consistent. So we also look at it from that perspective. It doesn't mean, though, that we simply adopt IFRS in all instances, but we do look at it and we do recognize that minimizing those differences is important. And we do spend a lot of time with the international standard setters. One of the reasons we're here in Japan is not only to have the opportunity to meet with all of you, but because we spend time with the Japanese standard setter, and Nobu and his board, to understand what they're seeing and what they're working on and to get their reaction on our projects. They give us great input on the projects we're working on. That's all part of trying to make sure that the global financial system actually benefits from the best thinking around the world.
Thank you very much. Maybe one more question. Some projects lead to targeted improvements to US GAAP, and others lead to significant changes to US GAAP. How do you look at these projects? Any views on that? Maybe Hillary?
Sure. When I think of our standard setting, we're really focused on what are the priorities of our stakeholders and where do we need to make changes. I do think those changes come in a combination of targeted improvements as well as broader projects, right? If you think of some of the themes we've heard recently on more targeted improvements, I think that makes sense. We have a very well-established set, fairly complete set of GAAP. But certain transactions will come up that are new or different. And the question is, how do I apply those transactions to the existing guidance? So those type of targeted improvements, I think, are really logical questions and projects for us to take on, is to provide that clarity, but it doesn't require a fundamental relook at the underlying accounting guidance, just more application. But we do have certain projects and certain concerns that we hear from our stakeholders that are broader. One of them I mentioned a bit was related to hedge accounting. Hedge accounting is guidance that we issued over 25 years ago. And I would say it was kind of issued in a slightly different environment. The derivative market was fairly new. How companies were using derivatives to manage their own risk exposure was in its infancy. And the hedge accounting model was really drafted in a very specific way I would say it was written as a privilege. You had to earn the right to apply hedge accounting. And from our perspective, that's very different than today, where companies are using derivative instruments to manage their risk, deal with their risk management issues. All companies are doing that. So a better reflection of the economics is to really help to show how those derivatives that companies are using to manage their own risk exposures, making sure that's reflected in a way that's transparent to investors in the financial statements. So I think of this as really a project of, should we be kind of re-looking at the hedge accounting model, not to make it a privilege to apply the hedge accounting model, but to really ensure that what companies are doing from an economic perspective is reflected in the financial statements. And we've also heard over time, right, because of the type of standard, it's very rules-based. We have a lot of guidance related to hedge accounting, that you end up in situations where there's a lot of what I would call foot faults. Circumstances where, because our guidance is so strict and strictly applied, that you can have instances where your relationship, your hedging relationship is still very highly effective, but because of certain technical nuances, you'll end up having to stop applying hedge accounting based on the guidance that we have today. And that's not necessarily helpful from an investor perspective, right? Because that can have significant consequences for the income statement, right? Can result in significant gains or losses that show up in a period that really don't relate to anything that happened from an economic perspective, from a transactional perspective during the period. So that is certainly a project where I think a broader look at that project is likely warranted. And I think that's really where we focus on, is there a case for change, especially for those broader projects, right? We understand that if we take on broader standard setting, that impacts even more of our stakeholder groups, and there are costs associated with that. So that's certainly something that we want to make sure is being reflected, but we have to be very careful of with regards to evaluating the benefits of those type of broad standards.
Yes, thank you very much. Maybe I'll wrap up the discussion about the agenda consultation and move on to some of the projects that you have completed or are very close to completion. One of the major projects that you've completed was on the standard on disaggregation of income statement expenses, which the FASB has worked on in some form for many years. I think Hillary and I worked on a very older version of the project 20 plus years ago. Can you give us an overview of what this standard would require, and what do you think was a factor that made you successful in actually finalizing the standard?
No, thanks, Nobu. So, as we mentioned, this is a project that in one form or other had been on our agenda for over 20 years. And during the course of that period of time, I think that the different boards explored many different options. They explored effectively a remaking of the entire financial statements, linking the balance sheet, the income statement, the statement of cash flows, something that certainly would have had a significant cost in the capital markets. And to be fair, I don't think we heard necessarily a lot of endorsement from investors that those were some of the solutions they were looking to. So as part of the agenda outreach we did, we went back to investors and actually ask them, what are you really looking for? And probably the best way to describe it is this. If you pick up a financial statement for a commercial company today in the U.S., and you look at the balance sheet, for almost every balance sheet line item, you can go into the footnotes, and you can get some detail of what makes up that balance sheet line item. But try it for the expenses on the income statement. We have Fortune 50 companies that have 3 expense line items in the income statement. If an investor wants to understand what's in those 3 line items, really the best they can do is start going through all the footnotes, trying to find expense information, which sometimes you say which line item it's in, which line item it's, sometimes you don't say what line item it's in. And in our outreach with investors, what we found was for many industries, it's the income statement that they spend the primary time focused on and trying to understand. Also add to that we had just completed a revenue recognition standard, which provided additional transparency on revenue. We already had some baseline income tax expense disclosures. So really what we had things like SG&A costs, cost of goods sold, R&D expense, where there was a single number on the face of the income statement, but there wasn't an understanding of what the drivers were in that number, not only in the current period, but in a change from year to year. One approach we could have taken would have been just said, well, give us all the detail of what's in that income statement line item. That didn't really make a lot of sense. That seemed like that would send people down an endless path of more and more information. So we again went back to investors and said, what are you really looking for? What we heard was they were looking for information on compensation because they'd seen variability in compensation pretty significantly. And they wanted to understand how compensation actually plays into the SG&A, the cost of goods sold, and so on. We also heard there was a particular focus on non-cash items. So think about depreciation and amortization. There's a reason that investors often want to isolate those items and sometimes for different calculations back them out. But they were left with effectively to do that, just 2 broad items in a statement of cash flows that, to be fair, are sometimes determined on inconsistent basis from company to company. And we also heard that when it came to cost of goods sold, recognizing that because it's absorbed and then it's charged off in a subsequent period, they were really focused on what was happening from a purchasing perspective. So that's actually what we focused on, Nabu. And it might be easier to see it with an example, and I do think we have a couple examples, and Jack, maybe get you to jump in here and talk a little bit more about how it works, how those examples work.
Yeah, this is probably a frightening example. We'll go through it in a minute, but maybe if we back up one slide, I'll walk you through kind of some of the detailed requirements of the standard, and then we will look at the picture again. So, as Rich mentioned, the objective was to improve the disclosures and provide more details. He also teed up how more details could be a broad spectrum of items, and I'm going to tell you where the board ended up. So if we go to box 2, you'll notice that, first of all, these disclosures are going to be required on an interim and an annual basis going forward. And we'll talk about transition in a minute. And there's 4 things that have to be disclosed. First of all, there are 5 items that will be required to be disclosed to the extent that a company has them each time. And of course, materiality always applies, but to the extent that companies have these items, they need to report them. They need to report purchases of inventory, employee compensation. This has a big connection with the human capital, of course. Depreciation, intangible asset amortization, DD&A or depletion, and all of these need to be disclosed in reference to the relevant expense caption. A relevant expense caption, for example, would be cost of sales. We'll demonstrate that in a minute. Now, if certain amounts are already required to be disclosed in the same captions, e.g. cost of sales, then those disclosures will need to be shown along with the disaggregated disclosures. What do I mean? Warranty expense. We'll show in the picture in a minute. A company also will need to disclose a qualitative description of the remaining amounts in the relevant expense captions, again, what the big items are and cost of sales. And then finally, there's a requirement to disclose selling expense. Now you say, what does selling expense have to do with the other four? It was just a debate item, and the board concluded that selling expenses need to be disclosed. This is going to be effective in 27 for annual reports, and then effective for interim and annual reports starting in 28 for calendar year companies. So, it's coming around the corner. Now, add 3 months for the 331, and we'll turn the page and take a look at the example. On the left-hand side of your page, where it says consolidated income statement, this is your income statement, and we're going to show how items are being broken out of cost of products sold. So on the right-hand side are the details that would be provided in the footnote. Important to this are the various components and where they come from. So the green boxes are the required expense categories. Those are one of the 5 items. The red boxes are other items that are required for that caption, okay, that relevant expense. That is, in this case, as an example, warranty expense, because this company has warranty expense. And then other cost of goods sold has a little A by it, a footnote by it. And that footnote describes the amounts that are otherwise in there. And then in the gold box is a change in inventory and other reconciling items and adjustments. Now, the change in inventory is there because the company has elected a practical expedient called the cost incurred method, because sometimes these items, if you have inventory, are included in inventory. And that was a practical expedient that was added at the feedback of the stakeholders during the comment period. Then finally, the board also made a notation that estimates or other methods that produce reasonable approximations required to be disclosed may be used to determine the amounts. And the reason they did that was for request about what level of precision is required in terms of internal control reporting. So.
Yeah, and maybe, Nobu, let's go back to my initial comments. So once the standard is adopted, to the extent someone's income statement, say, has an SG&A line item, if that SG&A line item has depreciation in it, amortization in it, compensation in it, what you'll be able to do is see a table in the footnote that provides the details of the items that are in that line item. So it will no longer be simply SG&A. It would break out the amount of compensation, the amount of depreciation, the amount of amortization, and any required disclosure that's there. So it'll effectively provide a similar level of detail for those income statement captions that we provide on the balance sheet for the balance sheet captions. One thing we were careful here, though, was there were some entities that were already presenting this information on the face of their income statement, and we weren't creating an additional burden for them. So think about some of the financial institutions, some of the airlines. When you look at their income statement, they may have a line item called depreciation. Well, there's nothing else they need to do if that's solely what's in there. Or they may have a line item called, salaries and compensation. So the way we designed this was that when it was more of we call SG&A, we would call that a functional category. When it's more of a functional grouping on the face of the income statement, that's when the breakout by the what's driving the underlying expense became more important.
Thank you very much. Jack, I think you mentioned that the standard will be effective 27 for calendar companies. Have you heard anything from preparers or other stakeholders about their preparation?
Yeah, so I'll share the comments I've received. I will ask the board members afterwards anything incremental that they have heard, because in fact we're out interacting with stakeholders at various places on a regular basis. So I've been surprised, this is my personal view, that it's been largely quiet, much quieter than I expected, given the nature of the change, that there would be a lot more questions and the like. I've heard mixed feedback. Some say that, oh, well, I have to do a lot of system changes. This is a big effort and will require a lot of work and will take that full couple of year period to prepare. Others have said, we're already ready to go and have it fully implemented. It wasn't a big deal. I think a couple of determining factors go to that is the level and sophistication of systems and ability to gather data and extract data from company systems. Second of all, I think centralization matters. If you have multiple systems throughout an organization, that's a little more difficult than if you have more of a single type of system. So I think all those things are important. I was at a major preparer meeting the other day. There were probably 50 to 100 preparers there of large companies in the U.S. and we had time afterwards to converse and share views, and the topic came up. And the comment was made to me that cost incurred was very important and a quote, lifesaver, I think is what they said, about, making this operational. So they were very happy at the compromise that the board drew there. And we moved on to other topics, frankly, and I think that's a good perspective. And I think most meetings that I've been to, it's a little bit of effort up front, but I think after the systems are in place, we're anticipating it not to be as difficult as the first time through. We take questions. We help people with questions at the FASB. We have a technical inquiry system on our website. And certainly we are there to entertain questions. We have not really received questions yet. I heard a couple might be coming as people are working through in some of the judgmental areas, but compared to what I've observed of other standards before I was there and when I was in a role in a national office, I think this implementation is off to a very good start.
And Nobu, part of it is us being able to articulate why this information is important. And to the extent that we can explain to preparers that this was the highest priority we heard from investors. We made some changes to make it more practical. We also gave a fairly extended time frame for adoption. Interestingly enough, some of those large multinationals, they're done already. It didn't take them much time. It didn't cost them much. But that's not the case for everyone. And so for the standard to be successful, companies have to be able to adopt it appropriately. They need the time. And we think ultimately we struck a balance there. But I do think one of the reasons you're hearing less pushback, as Jack mentioned, is really it's pretty hard to argue that having an income statement without any idea of what's in the line items makes a lot of sense, particularly when you have a set of footnotes that has an awful lot of expense disclosures, but it's a mystery where they are in the income statement. So I think that conversation kind of resonated with the preparer community as well, and that was one of the challenges for investors.
Yes, thank you very much. Maybe I'll move on to another project that you've completed, which is on the providing information on income taxes. Can you give us an explanation of what that new standard does and how you actually approach this project?
Sure. So this standard really is in that theme of disaggregation of financial reporting information. We heard a lot from investors that taxes tends to be a bit of a blind spot for investors. And what I mean is that really what investors are worried about is, okay, if something happens in if company has operations in a different country, what happens if the tax rate changes in that company? How is that going to impact the company? If there are changes in your local or state taxes, how is that going to impact the entity from an operations perspective? So what we found was that we have existing income tax disclosures that do provide some level of detail with regards to impacts from, let's say, foreign tax exposure, foreign taxes, or state and local, but it wasn't at that appropriate level of granularity that was really going to help investors to be able to understand what those changes would mean to a company. So what we've done is we've really just broken those disclosures out into some more detail. So if you go to, well, first of all, we did this in two different areas. One related to cash taxes paid. So the board did decide that for the cash taxes paid, that companies were going to have to break out or disaggregate the cash paid related to income taxes by federal, state, and foreign taxes. And you're also going to have to break out for specific jurisdictions if you pay more than 5% of taxes in that entity as compared to your total income taxes paid. So that gives you a little bit more detail of where you're paying taxes. But what we really, I think, is one of the biggest improvements, and if we go to the next slide, is our income tax rate reconciliation example. Now, this is very detailed, but really what the rate reconciliation is at a very high level is it really tells you how you go from your statutory tax rate, so what's your statutory tax rate, to what you actually end up paying, what's your effective tax rate. And really what's causing those increases or decreases in the tax rate. And we had this rate reconciliation in existing GAAP before, but it wasn't at that same level of granularity. And so I think some of the main changes that we made is we actually prescribed certain categories that had to be broken out in the rate reconciliation. So really, making sure that there's that consistency from company to company with regards to the categories to ensure that investors have that ability to understand whether they're going to be impacted by, operations in foreign jurisdictions, whether, how they look at their different tax credit structures. And so we have those specified categories required. And then we also have underlying detail associated with those categories if a quantitative threshold of 5% is met. So effectively providing some more detail with regards to the components of each of those different categories if they're considered to be significant for the entity by our threshold. So certainly the one that we have on this slide here is probably a very complex looking rate reconciliation table for a U.S. domiciled entity that has operations in many different countries. But we use this as an illustration of the significant amount of detail that will be provided to investors through this standard. So certainly I think investors have been very happy with regards to the information that they're going to get. This guidance is going to be effective for annual periods beginning after December 15th of 2024. So we will see these disclosures coming out from companies here in the near term. But again, really just an important project with regards to making sure investors can have that detail, but doing it at a reasonable cost, right? Really leveraging the existing disclosures that were already in GAAP and just providing some additional detail.
And Nobu, maybe one couple things just for our group here. Both the DICE requirement and this rate reconciliation and taxes paid requirement, those are public company requirements, not for private companies. The other one that I would emphasize is that all of these are subject to materiality. So While we've given you a fairly detailed example on the rate reconciliation, while Hillary talked about 5% of taxes paid, those are all subject to materiality. So to the extent that they're not material, then someone would, just like any other immaterial item, they would likely not disclose them. We prepare detailed examples to help illustrate, but it doesn't mean that's necessarily what you will see, particularly on certain entities.
Yes, thank you for the clarification. Just one more on the reporting. I think you also completed a standard on segment reporting. Can you just touch on what you've done with that?
Sure. So our segment standard was issued in the late 90s. And effectively, our segment standard is a management approach to providing a user of the financial statements with operating results by segment, the way management manages the company. That's the whole purpose there. One of the elements there is segment profitability that is disclosed is based on the management view of the business. So it means it may not be the same as what's presented on the face of the income statement. It could be a different type of measure. But what it doesn't do is provide really any details about the expenses that go into that management determined segment profitability. We'd heard pretty consistently that was an area that investors were struggling with. But we also heard that investors really liked the management approach. So what we ended up with was, to the extent there are significant expenses that the key management, we call it the chief operating decision maker, is reviewing related to those segments, they would be presented in the segment footnote. So they have to be significant, and they have to be reviewed by the chief operating decision maker, and they're on the same basis as segment profitability. It was something the board explored back in the 90s and said they would revisit. To be fair, where this project came about and what we focused on here was that. I will tell you, we heard lots of different things about segments, but ultimately what caused us not to change the overall model was we heard that the overall model was widely embraced by both investors and preparers. It was the chance that management had to tell its story based on how it operates its business to its investors, and we did not want to change that.
Yes, thank you very much. So it seems like we're seeing a lot of improvements in terms of how the financial statements look like. So not necessarily all the debits and credits, but we'll like to see these financial statements based on the new requirements in the coming years. In the interest of time, I do want to touch on the two invitations to comments that we haven't touched on yet. I think we talked about the agenda consultation, invitation to comment, but I think you also issued one on intangibles and the other on financial key performance indicators. Either one, do you have any comments on them? Or?
Sure. So once again, an invitation to comment, it's not a board document. It's a staff document done at the direction of the chair. And it's really designed to get additional information for our board from our stakeholders about whether there's a project that we should be pursuing. So specifically when it comes to, let's talk about, I'll talk about financial KPIs. Maybe Jack, I get you to talk about intangibles. Financial KPIs. We often hear from some stakeholders, they say, hey, there's all this non-GAAP disclosure of financial performance. There's EBITDA measures, there's free cash flow measures, and they're used by investors. Management's talking about them all the time, but guess what? They're not in the financial statements. And so some have asked us, could you pull those into the financial statements? Others, we talked to preparers, and they say, well, why would we pull it into the financial statements? It's already being conveyed in another form. It's satisfying everyone. People can see them. There's detailed requirements under the SEC rules about reconciling them to the financial statements and defining what's misleading and what's not misleading. So what's the problem there? So given those different views that we were hearing, we thought it made sense to take the issue and put it out to all of our stakeholders to give them a chance to respond. There's certainly not an easy answer here, right? One answer is do absolutely nothing. One answer is maybe you could define certain financial KPIs. Say we defined EBITDA. That sounds great, but it certainly doesn't make any sense for a bank to disclose EBITDA. It only makes sense for some entities to do it. And even if we were to define it and require disclosure of it, there's a question of, well, that doesn't mean there's not still going to be an adjusted EBITDA in the press release and being used by investors and others. So we pretty much highlighted all those issues, those potential areas that we could look at. We've issued it for comment. We've gotten the comment letters back, and we'll be bringing that back to our board with the input to see if there's a project there. But I would tell you, if there was an easy answer, we probably wouldn't have had an ITC. But I think it's good because it was one of those recurring themes that kept coming up that I thought it was important that we get our stakeholders to weigh in on before the board makes a decision one way or the other.
Great. I'll offer a few comments on intangibles. When I returned to the board a year ago, there were 2 or 3 topics that every meeting that we went to engage with shareholders, advisory meeting and the like that would come up, and one of them was intangibles. It also came up in the last consultation back in 2020 and continues to come up. So we issued an ITC that said, okay, there are a lot of views on intangibles. What is it you want us to work on? How should we go about it? And do you have any ideas? Well, I'm proud to report out that specifically we ask, do you want us to work broad or narrow? Focus on research and development, disclosures? Do you want us to take a look at the differences in the basis for which exist among intangible assets based on how they're acquired, whether they're internally generated, whether they are purchased, or whether they are acquired in a business combination? And the views continue to be all over the board. They continue to have a variety of different thoughts and also a broad variety of different priorities. Some of the people that responded said absolutely low priority, others say first priority. So I'm not exactly sure where we'll go. We're in the process of working through the comments, and we'll be discussing it with the board in the fall. And it'll be interesting to see what we do. I would say that probably the 2 most popular comments are there might be an opportunity to do some additional disclosures, and there might be an opportunity to address this acquisition basis difference.
Thank you very much. Actually, I did have a lot more questions to ask you, but in the interest of time, I think I need to give up some of them. What I'd like to do is I'd like to ask each of you for any comments or anything that you want to tell our audience today, and some of the questions that we didn't answer today, anyone that you think is important, that'd be very helpful. So maybe start.
Sure. I think one thing I would just like to implore, right, is kind of what Rich had mentioned before with regards to the importance of engaging with not only our stakeholders to understand priorities, but also engaging internationally. Right? I think that's one of the things that we really do think about is, good ideas can come from, they don't have borders, right? And we're always willing to listen to those different perspectives. But I think what's really important is just making sure, from our perspective, is understanding how transactions should be reflected in a neutral and unbiased fashion, right? And I think that's what we're really focused on from a FASB perspective. So each of the different, standard setting boards, whether it's the Japanese standard setting board, whether it's the, ISB, right? We're all looking at, in some cases, the same topic, but we may have different stakeholder views and perspectives associated with that topic. One thing I think is interesting, just listening to Jack talk about the intangibles project, that's a project that also the ISB is looking at. And from a global perspective, we certainly believe that there's an importance of, we wouldn't want the 2 boards going in completely different directions necessarily with regards to that, with regards to a project on intangibles. But I think think it really depends on how standard setters look at those projects, whether it's a very broad project or a more narrow project. And I could see there being certain scenarios where one board may decide to look at one of these issues more broadly, and another standard setter may decide to look at some of those issues in a more narrow fashion or more targeted to address some specific issues from a stakeholder perspective. So while I think in certain cases that could be perceived as not being convergence globally, I think it's just a different approach to potentially looking at those type of issues. That doesn't mean that we won't necessarily get to more similar conclusions for similar accounting for transactions, as Rich mentioned, but it can be different approaches. So certainly I think it's just really important from our perspective is to make sure we're listening. We're listening to all of our different stakeholders, which include all of the international standard setters as well.
Yeah, maybe I will comment. I want to thank everybody here for being here and for writing comment letters. As a staff person, we can talk at high levels and these type of forums and gather information, but those comment letters are really important to our process because that's where we get the details to really think through the ideas and the suggestions. And we take all of them very seriously. The board members all read through the comment letters as well as us, and we go through an analysis of everyone. And that thank you goes whether it's to us as the FASB, to the SBJ, or to the ISB. It's really helpful to the process.
I'd probably go back to some of the initial comments. And when Nobu, you asked why we were around for 50 years, and I mentioned one of the things that I thought was important was that we were specifically focused on financial accounting reporting for the capital markets. I'd come back to that because that's how we set standards. When you see we're talking whether it's a disclosure standard or an accounting standard, we're focused on the information that will help make the capital markets more effective and efficient. There's always a temptation to put your thumb on the scale and make something look better or worse for reasons other than best portraying the economics. We hear that input. That's a public policy matter, though. That is not the role of a standard setter. And we need to keep coming back to and staying focused on that best portrayal of the economics and sharing the information to make the capital markets work. One of the reasons that we're able to do that, though, is because of the support that we get from our stakeholders to stay focused on specifically that. It's the preparers who say, hey, I've got to talk about my business, and I need to talk about it and best portray the economics. It's the investors who know that they're actually making a decision to invest or not invest. And once you start altering information to try to drive behavior, you've taken that away. So I think that's there too. And I think from the auditor's perspective, there's no doubt you have a significant role in all standard setters process and bringing it back to and making sure that we have that discipline and stay focused on the best portrayal of the economics, I think is key to our success. And I think it's the key to how well all of our markets will work.
Yes, thank you very much. I did realize that I do have time to say my closing remarks, but rather than that, I'd rather ask one more question to you, if that's okay. One of the questions we did get is about the effect of the change in the presidential administration and changes in the regulators. Does that impact you or not? Maybe if you can allude to that.
Yeah. So Nobu, I think you and I discussed. I've been the FASB chair for a little over 5 years. There's been 3 presidential administrations during that time. There have been 3 chairmen of the SEC, 3 chief accountants, and I'll go back to my prior comments. Focused on what we do, the narrow mission that we have, and solely focused on that. That's what we would say in the U.S. That's a bipartisan issue, meaning it doesn't matter which party's in charge. That's a message that resonates with all. And it's because we stay narrowly focused on that. We don't wade into public policy because the moment we do, it would go one way or the other. So I would tell you, different administrations, it's possible through other actions that they have that new transactions will come about. So, for example, one of the impetus behind our government grant accounting project was during the last administration, there was a lot of government incentives in the U.S. And it was certainly recognized that we didn't have a standard that addressed it. It's one of the reasons we addressed it. So we were actually responding to what was happening in the marketplace by doing that standard setting. The current administration seems to have some views on digital assets. It may be that additional accounting issues arise as more and more entities get into that space. To the extent they do, we do have an obligation for transactions and making sure that they're best recorded to reflect the economics of those transactions. So that's something else. So I would say it's out of the political end. Our board doesn't change in presidential elections. Our staff doesn't change. We're here and we're focused on the same mission, no matter who's in the White House and who's in the SEC.
Thank you. So if we read the news, there's a lot of talk about crypto assets and how that might change. Do you have any observations on that?
So we did do standard setting on digital assets a couple of years ago, and I mentioned that earlier in the accounting there. There is likely, I guess, legislation just passed in the U.S. related to stable coins. And depending on what the features are of a stablecoin, it's possible there will be some accounting issues there, principally around whether or not an entity has access to cash with that holding or not. And if they have access to cash, is it a financial instrument and could it be a cash equivalent? I think that would probably be some of the questions that we could get. If they don't have access to an underlying asset, it's probably already addressed by our standard as an intangible at fair value. So I think that's there. I also think there's some transactions that involve, in the security space, you call it securities lending, but in the crypto space, they call it digital asset lending, where there may be some questions about does the derecognition guidance under current GAAP best portray those transactions or not. So that possibly could be something else. But I would go back to the criteria that Hillary mentioned earlier, talking about agenda consultations. Is it prevalent? Is there an identified scope? And is there an achievable objective? And we would all evaluate those three things as we evaluate any project.
Thank you very much. I think we're running out of time, and I think we really learned a lot from you. I would have loved to hear more from you, but I guess we're running out of time. So thank you very much for all your input, and I think the audience has also enjoyed listening to you. So maybe I'd give a round of applause to our panelists today. And as I said, I will skip my closing remarks given the time. But thank you for coming today. And as we announced, we will put the archive video on our website in the near future. So those who could not come today have the chance to listen to what we have discussed today. So thank you very much, and thank you all. Thank you.